I am going to be a huge contrarian to everybody else who says, be careful, be careful, be careful, have tight stop losses, tight stop. But tight stop losses, I am certain, is the main reason why most traders don't make money. Because before a trade moves your way, it usually moves the opposite way, because the people in the market they have to make money from you, and they know they're gonna close you out, because most of you have tight stop losses, so you never get to make money. I'd say if you're confident about a trade, don't have tight stop losses. Have a big gap between your stop losses. So if it goes down and it backs up to where you want, you're still in the trade and you're not taken out. I would say stop losses is the main reason why most traders don't make money, even when they get it right. When they know the direction is right and they still get taken out, it's because of your stop losses. I say, don't listen to anyone who says have really tight stop losses. If you are confident, don't have tight stop losses. You will lose money even if you are right in guessing the direction.
Are they ever a good idea?
They're good ideas sometimes, but then I would say if you're not sure about your trade, then don't do it. Don't do it. It's a good idea if you have a huge position that, over the weekend or whatever, some massive political event is going to happen, and by the time you can catch up with it, it's too late, you're wiped out. So in that case, it's good to have a stop loss. But still, I would say, don't have your stop losses too tight if you can help it. You have to judge where you are, what time of year you are, what's going on geopolitically, whether it's safe generally to keep your position open without a tight stop loss. Stop losses, I would say, if there is a research done, that people would find is the main reason why when they guess the market direction right, they never made money, because they get taken out. And the people who run the markets, they know their game. They know if they go down before they go up, they're taking you out.
It's always looked upon as negative, certainly at the retail trader level. Institutional traders are taught from their first day that they buy good levels or they don't buy at all. Unfortunately, most retail traders will wait for some confirmation before they get in. That could be a candle pattern, could be a moving average cross, or whatever. Institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are. I think that institutional traders are just doing what institutional traders do, putting their entry points at very good levels. However, if you are trading at the institutional level, it's not always easy to get filled. At the retail level, if you want to buy 100 shares, you want to buy the pound against the dollar at a 5 or a point, you press the little button and you've got it. At the institutional level, it's not that simple, and you've got, on occasions, to actually generate the liquidity to get aboard. I don't think that anybody looks at where the stops are, but they will say to themselves, well, we know pretty sure that most of the stops will all be crowded around this obvious level. So they will bid the market at that particular level. All you need is one person to chicken out, and the markets are going to go where the bids are, and all those people will be taken out. If you do not think long and hard about where you're going to put your stops, that you're going to find that you can quite easily die in a sea of stop losses. And here's an exercise for some people. The next time you're just about to put a trade on, you pick up something heavy and you just go poof. And then you write down on a piece of paper where you're going to buy and where you're going to put your stop loss. Don't buy it, but put an order in to buy it at where you're going to put your stop loss, and then just watch how many times the market goes to your order. Markets will go to the obvious stops most of the time. And one of my rules is that I want to put my entries where the masses put their stops. If you don't get in at a good level, there's nothing that upsets me more than a guy saying that this is a very risky trade, I'll use a tight stop loss. That's just rubbish, because you'll get stopped out over and over and over again. The stop needs to be where the stop needs to be. So if your entry is sloppy, then your stop loss is going to have to be a red bus away from where you got in at to give yourself a chance of staying in the move. The average true range will help with that. Most traders will look at a stop loss of 2.5 times the average true range or something like that. Nevertheless, if you want to get in with low stop losses at institutional levels, you've got to be brave. The institutional traders will use Fibonacci levels, they will use trend lines, they will use simple horizontal support and resistance levels to actually look for confluences to try and place their orders. Nothing clever, okay? Unfortunately, most retail traders, as I say, will look for some form of confirmation and their stop loss will then be too close and they'll get taken.
Some of them love it and some of them hate it, and I think you have to really specify what you mean by technical analysis. If technical analysis means optically looking at the chart and looking at heads and shoulders and stuff like that, it becomes very difficult to test. You see, you might look at this today and see it's a heads and shoulders, and in 5 years' time you might see something completely different, maybe a cup with handle. What influenced you to make those choices, you can't determine, you can't test. So as long as the thing isn't, you can't write it down as a set of rules that, you know, even a guy that doesn't speak English and sits in Mongolia can replicate, then it's not useful. There's obviously another set of people that say, well, it's more of an art than a science. And hey, if they make money, who am I to deny another poker player's place in the sun, yeah? So ultimately, that's the really great thing about trading. Regardless of how you manage to get that black number at the end of the year, that's ultimately all that matters.
The question is this: if we are thinking of hedge funds, are they taking support and resistance into account before they're placing a trade or an investment? Now, it's important to kind of distinguish here what we're talking about. I would hazard a guess that hedge funds at the very top end, like your Bridgewater, like any kind of really big fund that's managing a massive amount of money, really doesn't care about this, because unless they've got a sub fund that's very technical and small, which I don't think they have because they've got so much money it wouldn't make any sense, they don't care about this because their holding times are much longer, they're much more interested in different things, which we'll get to in a second, so they don't. But then when we go down to the smaller end of the scale, like people who are still running funds, the couple that I've worked with have taken it into account because they're not a 100-man team, they're a small team managing a decent amount of money, but a modest amount when you compare it to the big guys, and the people in charge of making those trades may well have a decision-making process that is integrated with some kind of technicals, because they can do it, because they're not trying to move 200 million around. Then maybe they're moving 20 million around, 30, 40, 50, that kind of stuff, which is small change compared to the billions up there. So if we look at this process, a hedge fund investing capital isn't going to care about support and resistance because they're looking for an edge elsewhere. Maybe they're looking for an edge in some emerging market that someone hasn't seen. Maybe they've recognized that this specific currency is going to be devalued more against this because they've got information that retail's going to struggle here and the mining companies, all that, so they make a bet based on that. Now, they don't care about support and resistance there. Now, one caveat to that is that you may well get traders within the fund who are executing that may take a little bit of stock in terms of, no pun intended, of support and resistance if they are manually executed. So say they've been given an order to buy X number of shares in this company. Now, it's their job to get the best possible price. Now, they may well just put an algo in, and just time slices the order, volume slices the order, and they leave it and they're off, they don't really care. They may well do it manually, and there may well be a trader who's looking at charts like us, who's executing it in batches, and maybe he sees the price at resistance and says, well, I will just see, I've got another batch to do, I need to do it anyway, shall I just see if it backs off from this, because I think that we might back off, in which case then maybe they do. Is it kind of integral is the word I'm looking for, into their whole system and strategy? No, it's not. They're still going to buy regardless. As we go down, or up should I say, this becomes less and less likely. Traders don't really care about that, they just care about getting the order done. It's such a big order that it has to be done regardless, and little things like that aren't going to make a difference. But as you come down the scale into the smaller kind of regulated funds, then yes, you can imagine that there's going to be some traders in there, and they may well be sitting there saying, well, actually, you know what, we're going to take this order, but we'll wait because we're hitting resistance, or we're at support now, maybe we should start to scale into the position. They'll still have to take the trade anyway, but it might mean that they adjust the order as they're doing